Welcome to the Broken Pie Chart Podcast, episode 350. I'm your host, Derek Moore. With me once again, Shane Skinner and Mike Snyder. All right, so this week, apparently the market doesn't go up every day. We've noticed the Mag 7 stocks, all but really Apple, had some weaknesses this week. Shane, I'll start with you. I mean, you've been all over this week. You've been saying which of these is not acting like the other. It's Apple. But you feel like Apple took a while to take off. Is it just late to kind of reversing a little bit?
So I feel like we're in a really, really odd spot here because I think Apple was the late, or I shouldn't say late, but Apple was later to the AI play. Okay, than majority of the other Mag 7 names, as well as some of these high flyers that we've seen over the past 6 to 18 months in that space. With that being said, I've always viewed Apple as more of a defensive stock within the Mag 7. I'm not saying it's a defensive stock, but of all the 7 you could choose from, it's one of the more defensive, I believe. At the end of the day, you know, they haven't overspent from what it sounds like on AI yet. They've got the cash on hand ready to go. And, you know, I think this is a perfect instance of sometimes from a business standpoint, almost like competitive advantages don't always be the first to the table on the next new hot thing. Maybe let a couple other people go, see what works, see what doesn't, and then come out with the best thing in the end, which is typically what Apple does. So,
I mean, do they even have to come out with something though? They're letting all these other companies spend the CapEx, and apparently they announced this week they may use Gemini. I'm going to say it, not their words, to fix Siri, to make Siri actually competent. So, I mean, they don't have to spend the CapEx. It looks like they'll give. This is reported, I think, either in the Wall Street Journal or somewhere else. I saw it somewhere, and I'm sure it's true because it's online. $1 billion a year for Google's Gemini to power their Siri, their agent, you know, that can't even give you directions. So that should be better. And I think they already get, I don't know if it's been struck down, but weren't they getting $10 billion a year from Google to make Chrome the default search engine? Maybe that's been upended.
I already saw an ad for Chrome advertising that you can make it the browser on Apple. So that one's going to be interesting to watch. I think some of these numbers, you know, 10 billion's, you know, no joke, but at the same time, in the grand scheme of things, a couple billion to Apple really isn't that much. So
it's nothing. They're a $4 trillion company. It's nothing.
Exactly. Where my focus is sort of shifting is this just reshuffling of the board? And realistically, with the way the index has held almost positive today, as majority of the Mag 7 names has been down, you know, 1, 2, 3+%, depending on which name you look at. If you're going to make the argument or the case that, hey, the AI trade's dying down, it's unraveling, blah, 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 at the end of the day, Apple holding and everything else falling, I don't see that happening. So we very well might have just seen the last big dip before a rally into 7,000 at the end of the year. Maybe the sell-off continues next week and Apple is just going to be the last to go because it was the last to go up. So it might be the last to go down. We'll see.
All right. Well, the counterpoint is, so I think you're saying you wouldn't be surprised if we rally to 7,000. By the way, this is why, you know, generally we buy the market, we hedge. We're not trying to pick tops and bottoms, but this is all fun to talk about. Mike, you know, the thing I keep coming back to is earnings. And earnings estimates for the S&P 500 on a forward 12-month basis, I think they reached another new high. I'm pretty sure they did. This little pullback, and when I say pullback, it's not like we're off 10, 15%. It's like we didn't make a new all-time high this week. It's like Armageddon for the markets. But we pulled back on a forward PE ratio. The market, quote unquote, got a little cheaper based upon the forward estimates. I mean, in the end, Mike, it's all earnings. earnings drive over the long term the growth of equity markets. So I don't know, like, do you think this is healthy, or is this, you're calling the next bear market?
I try to stay away from calling those, but what are we off, like 3% from the highs, something like that?
Yeah.
So, I mean, it doesn't feel nice, but it's not that big of a move. And if you liked the market last week or 2 weeks ago, you got to like it even more today. I don't know that much has changed, other than it's gotten a bit cheaper. I think the stories still remain intact. The estimates are still strong, like you said. The only thing that's changed is the market's gotten cheaper relative to those estimates. And just to quickly touch on Apple, it was lagging from, that April sell-off. It did not recover as quickly as those other names. So now, other than Google, it's closed the gap on, Amazon, Microsoft. It's now outperformed Meta over the past year, but it had lagged for a while. So maybe this sort of resistance in Apple is just it closing the gap in terms of those returns. Google's still way outperforming it. But yeah, from a broader market standpoint, I think this is a healthy pullback. 3%, wouldn't surprise me if we sold off even a bit more, given how well the market's done. And I think those are good buying opportunities.
Oh, okay. All right. Let me make since you guys are taking the bull case, I'll decide to take the bear case. The bear case is that we get more of a re-rating on the market, meaning what people are willing to pay for future earnings goes down. And so, to give you an example, let's say, and I should have had this up here. So, as of the close, I think it was yesterday. Where are we at here? If I go to the consensus estimate, okay, so about $288.10 is the forward earnings per share on the S&P 500. So, if you go back down to, I'm looking for my calculator. Oh, here it is. So, we came into today, we're a little cheaper now, but we came into today right around the 23 PE. So what if we keep the same earnings estimates, but we go back down to a 21 PE, which is 2 PE points? That's 6,050. We're at 67.10 right now, something like that. Like, that's the bear case, that you get some sort of re-rating. And it doesn't have to be that earnings estimates have to come down. It just means that the marginal buyer is not coming into the market here. So, it goes back to why we hedge. Am I wrong there? Like, we could go up too. We can go up to 25 times forward earnings. The earnings estimates can go up. Shane, the other part of this too is, I'm a technician at heart. There was a upward trend in the S&P 500, and you can draw these channel lines, and you draw a line below the series of higher highs in the market. We sort of came down to that trend line, actually went through it at one point, and now we're forming what's called a hammer, a candlestick pattern called a hammer, that often you see at bottoms, or it signifies a firming up of markets. Like, on a technical basis, Shane, it sort of did what we thought it would do. We kind of said, like, yeah, the market probably pulls back to this trend line, and we'll see if it holds. Today it held. I'll let you know Monday, though.
Yeah, 100%. And it's such an odd situation from a technical perspective, because you have a name like Meta trading about 10% below its 200-day moving average, and the market's not even 5% off its all-time high. You tell somebody without telling them anything else, you just say, hey, Meta's trading, 150 points off its all-time high, roughly up near 800 down to, we're at like 620 right now. And again, it's about 10% below its 200-day moving average. You tell a technical person that, they probably assume the market's quite a ways off of its all-time high. Again, we're not even 5% off. So the index has been extremely resilient, just because one individual name or certain names take a hit doesn't mean that this money that's being taken out of those isn't just being repurposed into other areas of the market. If a ton of people take money out of the technology sector and go put it into the consumer staple sector, if all that's still in the S&P 500, then did the money really come out of the S&P 500? So we'll continue to watch breadth. And like you said, it's an interesting position. You keep bringing up the 90s. And I think from a technical setup, we also look very similar to that. We're at the top of a 5-year channel since 2020. And at the same time, we're at the bottom and holding on a 1-year channel since the tariffs situation sort of rallied in April. And so the question sort of becomes, okay, does the old 5-year channel break like it did in the mid 90s and we are just getting started with this? Or do we stay within there and we've got some further selling to go before now and the end of the year? Who knows? Again, that's why we buy and hedge.
Yeah, I mean, I also look there's a little bit of dispersion here, which we haven't seen. I mean, we've seen it at different periods, but I'll throw out some numbers for you guys. The S&P since October 31st through about 15 minutes ago when I did this, S&P's down 1.76%. That's it. Like, I know it seems like it's like Hawaii getting 3 whole days of shade. It seems like Armageddon for Hawaii just because it's not sunny. Like, we're down 1.76% in November. Okay. Meta down 4.5%. Nvidia down 7.5%. Apple down 0.75%. Microsoft down 4.1%. Tesla, I think, is down like 5.4%. The RSP, which is the equal weight S&P 500, weighting all the companies the same, is down 0.35%. So it's done, the spread between what the S&P is and has done and the equal weight. So you've got this dispersion, and we see these different periods where there is dispersion. But I mean, it's the other stocks really aren't selling off. Mike, what's interesting is I don't think the earnings were that bad for all of these companies. Your favorite is coming, I say this sarcastically, like the one you're waiting for is November 19th. Nvidia, I think it's the 19th. We can check that. So does dispersion mean anything, or dispersion kind of is saying that the market needs to work itself out right now and then it will figure out what it's going to do next?
Yeah, I think it's sort of working itself out at the moment. This market is very top heavy. Something like 40% of stocks in the S&P 500 are actually negative year to date. A little bit more than that in the NASDAQ and even more than that in the Russell. If you would have asked me to guess, I would have said that number was much lower, just given total returns. So we're talking about the re-rating of the market and what people are willing to pay in terms of earnings. It's really coming down to what people believe the capabilities and the potential are in AI and the spending in AI, because that's what's driving the returns this year. Is there a rotation into some of these other performers now? Because like Shane said, if you're selling these, top heavy, large cap names, where are you putting your money instead? Are you putting them into underperformers? And there's a lot of those in the S&P 500 itself.
I think the question, you're right. Where are you putting money? I will tell you that small caps have had outflows this year. So State Street has sent over a note, thanks to our friends at State Street. Sentiment and ETF inflows shine, market breadth dim. And so it looks like U.S. listed ETFs took in a record $171 billion in October, talking about the flows, pushing year-to-date inflows to $1.1 trillion, just $34 billion away from a new annual record, and on pace to hit $1.4 trillion this year. Okay. But there's some weakness below the surface. Not everything is setting records, nor is every risk on exposure. I'm quoting from State Street. U.S. small caps are the best example of this trend. U.S. small cap ETFs had $2 billion of outflows in October. This was their 8th month of outflows in 2025, an 80% outflow hit rate that ranks the worst of all time. The year-to-date exodus is $16 billion. So if this holds through to the end of the year, this would be a record amount of outflows in their first annual outflow figure since 2011. You can't see the chart because we were busy this week and we didn't come up with our normal charts, but just trust me. When you look at small caps flows in billions, like this is the last time there was a negative year, and it was slightly negative in 2011.
I was 14 years old. That's insane. That's like to think about, though. I mean, realistically, did I even know what markets really were at 14? Not really. So to be that long, that's another thing. This market has so many people in it now that I don't think were around for '08 or, potentially even 2020. They came in after. And it seems like everybody's willing to buy. And it's not necessarily in small caps, but it's the bigger names. They just continue to see the larger inflows.
Derek,
if somebody was 22 years old in 2008, they're now 39. And if somebody in the year 2000 was how many? All right, so that's 25 years ago. Yeah, so they're 45 now. Am I getting that right? Yeah, I'm getting the math right. And to have been in the markets in the 90s, I mean, you're my age. So, yeah, I mean, I think your points. I think the reason you bring this up is that you've got a lot of people who have never really seen a bear market. Now, I don't know why. It seems like people forget that we had a bear market in 2022 into 23. I don't know why people never talk about that.
Yeah, no one even, because of how high we are now. It just, we made it back up in a year and then some almost.
Mike, I mean, the small cap thing, does that surprise you? It did me when I saw that note, just because interest rates are perceived to be coming down. That was like, hey, if we just get interest rates down, these companies are going to do much better on a cash flow and an EPS basis because their debt costs go down. But people are not, I mean, they're buying the large stuff, I guess, which was your original point.
Yeah. I mean, historically, I think when you think about small caps, you expect them to do well, in more, I guess you call it an economy-driven rally. I don't, where there's a broader range of stocks that are doing well. You would expect the small caps to outperform large caps, I think, historically, and it just doesn't seem like it's been the case recently. You would expect with interest rates coming down that this would benefit small caps, but kind of seems like over the last few years, you're not getting the type of return from small caps for the risk relative to the large caps. I don't know if this is a short-term thing or if this is something where, we need to start rethinking how we think about small companies and what their risk versus potential return are.
You know what was never a small cap? OpenAI, SpaceX, Stripe.
Right.
Like the companies they're not starting and going to the capital markets as an IPO when they're smaller and going into it. Like if Apple was started, I don't know, in the last 10 years, they would have waited until they were, I don't know how big. Like, I guess that's the thing. Like most of the big tech companies, they stay private. I don't know if you have any thoughts about that, Shane, but I mean,
that's
small caps are different.
That's what I was going to bring up is like, there's so much incentive. These companies are incentivized to stay private for quite a while for a multitude of reasons, I think. And then on top of it, too, realistically, this isn't the 1970s, 80s, 90s, where America's corporate atmosphere and environment is sort of finding out who are the real leaders. And don't get me wrong, that evolves and change. We look at data on that stuff all the time, at who are the biggest companies in the market. But at the same time, where we're at in the corporate sort of atmosphere in 2025, I think is different than it ever was 20, 40 years ago. And, people talk about like the .com bubble and, Amazon fell 80 something, 90 something percent, right, before it recovered. And I'm not saying that it's not possible for Amazon to do that again, but I just don't see Amazon being what it is now, that happening, right? It's changed. And so I think that these big names are so big that they have enough money, they have enough influence, they have enough reach to where anything that's worth anything that's small will get scooped up by them. And if it's not something they can scoop up, like you said, Derek, it's going to stay private until they have to take it public, or it's big enough to do so at that point and make it worth their while.
Well, I mean, if you want to look at, so I think, was it Kenvue? There's an offer for that company. Isn't somebody trying to buy them? I think that was announced. KVUE. They are in the S&P 500. And we've talked about this before, where I like to watch VXF. That's Victory X-Ray Frank. It's a Vanguard Extended Markets ETF. And it's kind of like, okay, beyond the S&P 500, what are the next names? And I like to look at this, and I'm looking at the top holdings in this: Snowflake, Marvel, and sometimes there's a lag. Will it be in this fund, and they're also in the S&P? I think not MicroStrategies. Super Micro, I think, was in this. But there's Carvana, there is Roblox, Vertiv, Cloudflare. Let's see, SoFi is in there. So I don't know. I mean, am I right? Is Kenvue, is that the one that somebody made an offer on them? And if so, when that goes through, they'll come out of the index because they're no longer, I assume, and somebody else will go in. So
yeah, it is. It's Kenvue. It looks like Kimberly Clark is.
Okay, so Kimberly Clark.
Yep.
And I love the new members. I love seeing when new members come in because it helps, I think, the growth of the index, and it's one of the nice reasons to own the index. But
it makes sense, Derek, why you're paying attention to that. I finally think I've got it, is because the index itself is almost like an equation, and you're just paying attention to the components that are coming in and out of the equation.
Did Mike? I don't know if you saw. I'm sure you listened to all. Was it 2 hours of the MicroStrategies, or what do they call themselves now? Strategy, the earnings call. I know you were probably waiting in the waiting room for a half hour for that to start. Aren't they? People are speculating that they'll get into. Oh no! I think it was on the earnings call in their deck. They talked about the criteria for inclusion in the S&P 500, and they made a point in the deck that they've met, I think, the inclusion. So they're a U.S. company. Because the accounting changes, if they have a gain in their Bitcoin, they could actually show EPS. And I believe last 2 quarters they've shown. Like, Mike, do you want to see them in the S&P 500? Or like the committee? I don't even know. Would the committee actually put them in? They just own Bitcoin.
Well, so I have to say I don't know enough about the committee and how they make these decisions, if they're just completely rules-based or if they have some ability to just say, we don't really like this. I sort of think if they meet the criteria, put them in.
I mean, there's other companies that meet their criteria, and Robinhood wasn't the number one company in this, for example, weighted in this ETF. The committee meets, and I wish I could find it, but somebody who used to be on the committee and is retired did a podcast with Joe Weisenthal and Tracy Alloway, Odd Lots podcast. If I find it, I'll put it into the show notes, where they talked about the selection and this process. But I think the people are anonymous because they don't want companies lobbying them. I don't know. I mean, that's a whole other story. And I think is the rose off the bloom there on MicroStrategies? I would say so. I think it's now trading closer to its intrinsic value, including the value of their debt. But
yeah, I wouldn't mind seeing it in the S&P. I mean, it's Bitcoin. Have a little bit of Bitcoin exposure in there.
Okay. Shane, you want, Mike is pounding the table on having strategy included. Are you the same way?
If it checks the boxes, it checks the boxes.
But there are other companies that check the box too.
And that's so it's up for debate why you would add one, not the other. We could sit here for hours and do it. I will say this. Everybody, it's the Kansas City shuffle, right? Look over here in one hand and I'm doing something over here with the other. And what I mean by that is if MicroStrategy or strategy now, if it either lands something massive in terms of lending and staking Bitcoin, like something happens at a level that it's now within the government, the Treasury, the Fed, like it's here to stay. There's something there. I also think they have the ability, while everybody's focused on, hey, we're just a Bitcoin mining firm and we just keep buying Bitcoin. They could shift focus, right? What if they have something going on in the AI space that they're not?
They have nothing going on. Like, seriously, come on.
Hey, probably not, but you never know. If there's a shift in direction or they've amassed enough money or enough positioning in Bitcoin, and if Bitcoin holds, it's sort of like, I don't know. It's, you've said, the correlation, it makes sense, right, to potentially you like watch the difference between MicroStrategy, right, and Bitcoin. You just look at like the ratio.
If you like Bitcoin, just buy Bitcoin or buy one of the ETFs. Like, what's the one?
There's a ton.
BlackRock. IBIT, is that the one? Yeah, that's one of the biggest ones, and that has a very, very close correlation between the price of Bitcoin. And so, if I was guessing, so here's the other thing: they look at the segment or the industry that some of these companies are in, and they might be like, oh, we already have too much tech. We'll add a financial company. We'll add a utility, or
keep adding.
But Snowflake is the one. I'd have to check their financials to see if they've. I guess I could do that. I mean, I have the stuff I can look at here, but as long as they're profitable, I think they can. They could be included in there. So.
Doesn't Buffett still have a stake in Snowflake? I think he does.
Does he? I don't know.
Berkshire still has a stake, I think.
Yeah, I'm looking at so if I look at their income statement and I'm doing this, let's see, key stats. Nope. Last 12 months, they have negative earnings, so it's not going to be them. All right, anyway, so that's why you don't do stuff live. So somebody else will go in. All right, so back to the markets, though. So I think the other thing that I'm seeing and just having conversations, I feel like the sentiment is very, very bearish. And it just, we talk to a lot of advisors, we talk to a lot of clients, a lot of people who are interested in using us to help them manage their wealth. And by and large, everyone has said to me this week, everyone knows the economy is not good, that unemployment is rising, and inflation's rising, and the market's in a bubble. Like, if I was to summarize what the sentiment is, which tells me that this thing is probably going higher.
It fits the narrative that we've been talking about of this being a hated rally. And now, there's a little bit of a pullback and can sort of lean into that and say, hey, I told you this isn't a strong market. Is it a bubble? I think we've also covered quite a bit about how these large companies, unlike other bubbles, have real earnings and real profits, and are trading at fairly favorable and, like we said, not cheap, although the valuations have come down a bit, but, reasonable valuations.
Shane, let's talk about Nvidia for a second. So somebody can check my math there. I think it's November 19th, Nvidia earnings. If we believe, I guess I should have checked that.
It is November
It's the 19th. Okay, so the 19th. I'm actually surprised, though, if you look at the option chains. So if it's the 19th, really the November 21st one is the closest in. And the at-the-money options, the implied volatility is kind of where it is for the 28th. And it's kind of where it is, let's go out to December 19th. The at the money, which is, 188 and change, let's call it, the 188 options, if there are those. Yeah, there are. The implied volatility is 50. I'm not seeing in the option chain yet. Maybe it comes in there. But Shane, I'm not seeing an implied volatility bump in the expiration that has the earnings in it. And I wonder why.
I'm seeing a straddle at 190 is costing you about $17.60 roughly. That's just under 10%. So pricing in just under a 10% move on Nvidia going into earnings. I feel like that's fairly normal. I don't think it's egregious. I don't think we're seeing for the movement we've had the past few days, I don't think we're seeing nearly as big of a potential move. They're not pricing in, at least at this moment, that Nvidia is going to swing 30, 40 points.
I don't think they're pricing in anything for earnings. This is my point. You look at the implied volatility for the 21st, the 190s. I'm looking at Bloomberg here. 58.39% is the implied volatility.
I wish there were studies on earnings over the past 3 to 5 years as these expirations have developed and we've gotten more listings, because I really think the standard has become something after earnings moves 10%, 5%, 0. The most extremes maybe 20 plus, but most things it seems like the 10% is the magic. It might move that or it might not.
But it's what I'm saying is it's 50 is the IV for the 190s for December 19th, the regular expiration, and it's 53 for the November 21st. What I'm saying is there's no implied earnings extra juice in those. Now, maybe that expiration would have been higher, but for some of the noise this week. Maybe everything else, the implied volatility got raised across the chain, and that is no different than the earnings volatility that's priced into the options. I guess that's what I'm saying. Normally, if you look at a chain, that's where the vol is.
It's all concentrated there.
It's not. You look at December should be much lower than the November 21st. It's not.
Do you think that that's also a factor of more expirations, more listings, and ability to spread risk throughout the curve?
I don't. I think it's because we looked at Meta. Remember, we looked at Meta. Meta was 70, and then a month later it was, I think, in the high 30s. Microsoft, same thing. Apple, same thing. So it's almost like, Mike, is Nvidia dropping from its? It recovered today. I think it was down to 182 at one point. Had a hammer on the chart. There's that hammer again. I'll let you know Monday whether it plays out. But Mike, it's almost like Nvidia's we're going to go down, so we're not disappointed around earnings. We're going to make the move now and make ourselves feel better.
Yeah, two things. I'm surprised about that at the money that Shane just talked about, 10%. That seems a little low. I would have guessed it'd be higher. I'm not buying that, but I'm certainly not going to sell that. As far as the volatility, if you look at next week's expiration, it is, at least what I'm seeing, significantly lower than the one after earnings. So I think there is some volatility being priced into there, and I think it's being spread out throughout future expirations beyond November 21st. I'm surprised at the level that it's being spread out, and that December is that high. But I do see some volatility priced into earnings when you compare it to next week's expiration. That said, I would guess that the volatility here, the implied volatility of the at the monies, is lower than it has been in quite some time around earnings. A 10% move seems relatively small to be priced in here, but the market knows. So,
well, and the market will know a little closer. My guess is when we record on the Friday, before earnings week, then we'll actually see it in there.
Sure.
That's my guess. If we kind of look in there. And so the 19th is what? 19th is a Wednesday. Yeah, so that Friday when we record, I'll bet you there's more of a, might be more of a bump in there. All right, I mean, I think sometimes markets trade on fundamentals and they trade on worries and this and that. I feel like this has become a technical market. Like today, we didn't quite get down to 6,600. There was a collection point there, but I think this is one of those, you got to sit back and just look at the technicals because nothing else materially changed this week. Shane, I know you would agree on that. I think we were talking earlier.
Yeah, no, I mean, realistically, there wasn't anything in earnings this week that was a huge fundamental change to the underlying market. I'm wondering if Powell's hesitation to confirm a rate cut, or even, we very well could see a rate cut in December, but he kind of walked it back, confirming it. He essentially said, which it's ironic because he'd never said this before, but he said, they shouldn't try to price in what they're doing in the future. Like they shouldn't expect that we're just going to do it because it's what's being priced in. And, I don't think this is a situation where Powell wants to necessarily cut personally, but at the same time, given what's going on in the broader market, in economy, the job market especially, like I just don't see how we're not going to cut rates or continue to. So market's sort of playing chicken right now, it feels like, right?
I mean, I would contend, does anything really change if they do reduce rates? Because they're already tightening by not letting the balance sheet run off. I don't know. We'll see. But by the way, Mike, have you been getting these cat pictures from Shane?
Every 30 minutes.
Every 30 minutes. Shane, there is a technical pattern that you call the Garfield pattern. And I get these, Mike and I keep getting messages from Shane with pictures that look like cats over a chart. And I see a cat with two ears. Do you just want to explain what you're seeing with some of these companies?
Yeah. It's just Nvidia fits it perfectly, right? We've got like this spinning double top. If you look at it on a daily chart, so it kind of makes the eyes and ears and whatnot. But it's interesting. We're seeing almost all the Mag 7 names double top with their all-time highs in some manner. Tesla just did it recently with its all-time high back almost a year ago, right? So you've got almost a year's time span with that one. Nvidia did it in a matter of a week. It's time, essentially. So, but it's interesting seeing all of these names in the Mag 7, minus Apple, essentially do one of these double tops. So we'll see how it plays out, but I couldn't help but notice it. It looks like Garfield. So,
all right. Well, I look forward to more cat pictures from you on whatever stock it is you're following. I know we're going to go a little shorter today. I guess the last thing I was going to bring up real quick is, did the top 10 change in the S&P due to the GLP announcement? So this week, I guess the Trump administration negotiated lower rates on the weight loss drugs. And so they had Novo Nordisk people there. They had Eli Lilly there. And let's see. According to what I'm seeing, Eli Lilly is listed as 12th in the highest weighted companies, although Google is in there twice and Berkshire. So who came out? So Nvidia, Apple, Microsoft, Amazon, Broadcom, Alphabet, Meta, Tesla, JP Morgan, and Eli Lilly. So it's sort of, well, in Berkshire. So no, they're not in the top. They're number 11, including Berkshire. So it hasn't been enough, right?
Right. Yeah, they were down a bit today. I don't know if that changed it, but no, not enough to get them to crack it. They've been close.
You know, surprisingly, Exxon is number 14. Weren't they lower than that? I'd have to look at their chart.
According to SPY's daily holdings as of November 6th, I have Lilly as number 10 if you don't count one of the two Googles and you don't count Berkshire. Nvidia, Apple, Microsoft, Amazon.
Yes, they are 10.
Right. Yep.
X Berkshire and X one of the Googles.
You're right.
That's right.
Visa and then Exxon and then Netflix, MasterCard, Johnson & Johnson, Walmart.
Yeah, no, it's people forget. They're like, oh, oil's not doing well. Exxon's done. They're number 14.
Yeah, they're a juggernaut.
So is Nvidia a $5.5 trillion company now? Is that right? Maybe I'm looking at the wrong thing.
I believe so. This is a fun one. Palantir's in the top 20. And Michael Burry Dr. Burry announced a large short position in Palantir. So that'll be a fun one to watch play out. He's trying to short a top 20. Again, not counting one of the two Googles and not counting Berkshire. Essentially a top 20 stock in the S&P 500.
Yeah. Well, when we have more time, maybe we'll look at I'd be curious, I like to look at those charts of the forward PE versus the stock versus the EPS.
Yeah.
I'll have to do that at some point to check to see if it's going up, if the earnings are going up as well. So, all right, let's go to any recommendations. Shane, I know you had some viewing last night.
Yeah.
Do you recommend that movie for the audience?
110%. Buy with both hands. Argo, fantastic movie. Well directed, well acted by Ben Affleck and Bryan Cranston. Great job. Everybody that was in that movie did solid, and the story was phenomenal. So great recommendation by you guys. Thank you.
Have you seen Good Will Hunting yet?
I actually haven't. And
all right. Well, that should probably be on your list tonight, too.
So there we go. Hey, my wife. Everything you've recommended so far, my wife has loved. She specifically told me this morning to ask for more today. So there it is. Thank you.
Yeah, Good Will Hunting. So Ben Affleck and Matt Damon wrote that movie. And I know it was nominated for an Academy Award. Robin Williams won Best Supporting Actor Academy Award. And I think they won for the script. I think Ben Affleck and Matt Damon won for the script. So Good Will Hunting. There you go. That will be my recommendation. If you haven't seen that, if you have seen it, watch it again. Mike, anything?
Nothing new. I haven't seen anything new, but maybe a little preview for next week. We're going to plan to watch this show, All Her Fault. It's like a mystery about a missing child, and they've narrowed it down to someone in the family knows where the child is. They just don't know who that family member is. So that's what we'll be watching this weekend, and I'll let you know if you should do the same.
A pre-recommendation. I like it.
Well, I
like it.
Yeah, I'm going to be an analyst on this show. That's basically what I'm saying here.
Okay. Yeah. You're going to be initiating coverage.
Yes.
And
I'm doing research this weekend, and I will have the recommendation for you next time.
Yeah. No, that's good. That is good. All right. I think that's it, guys. We did it, and we'll see next week where the markets kind of follow through on this hammer bouncing off the trend line. And, well, good luck to Michael Burry on his short. I guess we'll see how that works out. We'll see how that works out. All right, everyone. Thanks for joining in. You want to reach us, derek.moore@zegainvestments.com. I did have a listener question, but let's save it for next week. That's derek.moore @Z as in zebra, E as in Eddie, G as in George, A as in Apple. Spelling investments is up to you. If you can't spell that, you're not going to be able to reach me. Send us questions. We'll read them on air. right, guys, we'll see you next week. Thanks.